Right now, advanced micro devices is operating in a state of severe mechanical tension. It is an overextended asset, yet standard predictive models are misinterpreting the mathematical risk of a downward collapse. The active spot price for AMD is currently sitting at $521.54, an elevation that has detached the stock from its historical baseline anchors. This chart maps the exact scale of that dislocation. By locking on to the current spot price and measuring the distance down to the 50-day and 200-day simple moving averages, we see AMD is trading nearly 25% above its 200-day structural anchor. In market mechanics, this is classified as a critical extension profile. During periods of severe extension, retail algorithms and traditional quantitative models rely heavily on a specific gravitational anchor, the options market's max pain node. Max pain represents the specific strike price where the highest concentration of outstanding options contracts expire worthless. To minimize payouts, dealers systematically hedge their books, pulling the stock toward this target. But the order book is shifting. Market makers are dynamically re-hedging, recalibrating the weekly max pain node, pulling it up from a $465 baseline to a new $485 target. Standard analysis breaks down at this point. Conventional models look at this gap and predict an imminent volatility crush, assuming gravity will pull AMD straight down to that $485 note to settle the books. The math behind that assumption is incomplete. Forced dealer re-hedging, the process where market makers buy shares to remain delta neutral as call buying accelerates, is overriding standard options gravity. This points toward a breakout above the $527.20 all-time high. Relying on static downside targets during a period of systemic institutional hyperextension causes analysts to misread a coiled spring as a fragile bubble. To see why bearish models are failing, we have to look at the exact metric they prioritize: a sudden, steep drop in AMD's daily trading volume. This volume chart isolates the source of the retail concern. AMD's current trading volume is pacing at only 42% of its trailing daily average. Traditional market models take this low-volume metric, combine it with AMD's 98th percentile implied volatility, and output a sell signal. They are predicting a high-float theta burn consolidation. Because implied volatility is so high, the cost of option premiums becomes expensive. The resulting lack of buying power forces the stock to grind sideways, draining retail capital through the daily time decay of those contracts. In a standard theta burn scenario, option values evaporate, dealers unwind their equity hedges, and the asset collapses back down to the max pain node. But that assumes the lack of call buying volume is a symptom of exhaustion. Instead, this absence of retail call volume on AMD is the result of a deliberate institutional strategy. Standard algorithms misinterpret this quiet order book as structural weakness, missing the sophisticated institutional architecture being built out of sight. If institutional desks aren't buying 98th percentile out-of-the-money calls, we have to map exactly where their capital is going. This options chain matrix shows the flow of capital. Instead of chasing expensive upside, institutions are sweeping deep 25 delta put wings. They are purchasing blocks of downside protection to construct tactical collars, collateralizing their long positions. This pattern of institutional put buying alters the structural reality of the asset, establishing a mathematical floor beneath the price action for the week. When institutions buy these massive put blocks, market makers take the other side of the trade. To protect themselves against downside risk, those dealers are forced to buy underlying shares of AMD to hedge their books. This continuous dealer hedging creates a fortified wall of bids directly beneath the current spot price, establishing a hard structural floor at the $500 level. The retail market looks at the chart and assumes the asset is top-heavy and ready to fall. The institutional reality is a consolidation zone defended by non-discretionary dealer buying. By establishing this mechanical floor, the institutional collar prevents the theta burn drop and neutralizes the signals bearish algorithms use to forecast a mean reversion. While the $500 floor prevents a collapse, a separate macroeconomic catalyst is generating the upward velocity required to override AMD's localized options gravity. That catalyst is the World Semiconductor Trade Statistics Forecast, releasing an upward revision projecting a $1.51 trillion global sector expansion by the end of 2026. This creates a logistical hurdle. Mega-cap asset managers cannot allocate hundreds of billions of dollars directly into single equities like AMD without triggering massive price slippage on the open market. This split-screen diagram maps the solution. Instead of buying individual stocks, institutional capital floods into highly liquid leveraged conduits, specifically targeting the 3x leveraged SOXL semiconductor ETF. This concentration of capital has pushed SOXL into its own extension state, currently trading more than 44% above its 200-day simple moving average. The velocity of this inflow has rammed SOXL into its absolute option ceiling, the $300 call wall. This creates a systemic short gamma bottleneck. Market makers writing SOXL calls face infinite loss testing this boundary. To survive the squeeze and maintain delta neutrality, they are mechanically forced to aggressively buy the underlying constituent equities making up the ETF. This cross-asset forced buying acts as a direct transmission mechanism. It takes systemic macroeconomic capital and dumps it straight into AMD, rendering the localized drop in daily trading volume irrelevant. When systemic macroeconomic velocity collides with localized option gravity, velocity dictates the final price action. This data visualization tracks the empirical evidence of this phenomenon. We can see precisely how the mechanics resolve. Over the last 5 consecutive expirations, AMD has overridden its max pain node, closing at an average 19.49% premium strictly due to these forced gamma squeezes. Institutions discard standard retail gravity targets, calculating positions using the adjusted momentum forecast. This model applies a 15% gamma overlay adjustment for systematic dealer rehedging. The raw max pain nodes of $465 and $470 are crossed out, replaced by mathematically adjusted targets of $534.75 and $540.50. The immediate trigger for this execution sequence requires AMD to successfully defend the $510 gamma flip zone, the price where dealer hedging shifts from buying to selling at the opening bell. This technical chart plots the trajectory. Once that $510 pivot is secured, mechanical dealer buying triggers a bullish breakout, forcing a breach of the $527.20 all-time high. As soon as that historic resistance level shatters, the monthly trajectory locks in, accelerating the short gamma squeeze into a parabolic run. Relying on surface-level volume and simple options gravity creates a blind spot. Understanding cross-asset capital transmission and non-discretionary dealer mechanics is the only accurate way to map a market where institutional velocity breaks the standard rules of gravity.